Hello, and welcome to the video series from the Finance Library on financial metrics and KPIs. This is the first of a two-part series on the topic. You can find the two videos as well as other content on our website at the finance-library.com. Again, finance-library.com, and also on our YouTube channel at finance-library. Yeah, as we discuss the topic, there are going to be some references to certain kinds of analyses. The tools for these analyses are also available on the website, so you may want to check them out again at the website at finance-library.com. So let's start the discussion with why KPIs and financial metrics matter. As an executive, one of the things you routinely do is to develop and track key performance indicators, what are commonly referred to as KPIs, that allow you to monitor the performance of your team or your function. You know it's important because it allows you to know internally how well you're performing. And it also allows you to tell a strong story to your leadership. So clearly, having KPIs and tracking them is important, but it becomes even more important when you lead or are part of a function in a company that is non-revenue generating. So you can't draw a direct link between your activities and revenue. So the KPIs you pick and the financial metrics you focus become even more important to help you be in a position to tell your story persuasively. So now the reality, though, is that even when you think you're doing this well, right? You can often see a disconnect, and it's very common. I've seen it over and over again between the KPIs that the function is tracking and what the finance team seems to care about. So the function is looking at metrics that are useful indicators of the activities they perform as a team. For example, marketing might track impressions, HR might track training hours, operations might track throughput, and IT might track tickets closed. But as useful as these activity metrics are, they answer a question different than what finance is asking. What finance is asking is, what is the return on the investment in marketing? What is the return on investment in HR? What is the cost involved? What is the risks we face? When your KPIs, more activity-based KPIs, don't connect to those questions, your function becomes less visible in budget conversations. Again, not because your contributions are less valuable, but because it has not been translated into the language of capital allocation. So the goal of this series is to give you a sense of how you might do that translation. I'll start with a few metrics that are commonly used and very familiar to the finance teams. So for instance, if you are on the marketing side, you might be the activity may be tracking maybe impressions and reach and engagement, and whereas finance may be more aligned with thinking about it in terms of customer acquisition cost, lifetime value of a customer, the marketing ROI, the ROI on the marketing spend. So if you present your KPIs, activity-based KPIs, what you're missing is the dollar linkage to the metrics that finance is looking for. Similarly, when HR tracks training hours or headcount, the focus is on the input, not the outcome. And so what finance may be interested is in cost per hire, revenue per employee, other finance metrics that the team recognizes. You can see similar kinds of themes show up on the IT side as well, where you might have an excellent tracker that looks at the tickets closed and how soon tickets are closed and uptime and so on. And again, the translation needs to happen. For instance, if it is uptime or downtime, you're looking at, hey, what did that downtime cost? What does that mean for our revenues? What is the per incident cost of such downtime? And then from a operation standpoint, you might be looking at how efficiently your equipment is being used. What is the throughput? You might track the number of units being produced, but it's the value and the defect cost rather than the defect rate that may be more relevant. Value versus volume kind of consideration that may be more relevant for the finance team. Now, these are just some indicators. So to make this a little more real, I'm going to start looking at how to go from activity-based KPIs to finance metrics. So to do that, it is helpful to think of it as a three-step process or a three-layered stack, if you will. On the top of the stack is activity metrics that are routinely used by various departments and functions. And at the other end are the financial outcomes, which is what the finance team is most interested in. And in between is the operational or the business impact. So one of the things that you can do is look at all your activity metrics, such as completion rates or participation, which are all, again, helpful but insufficient on their own. The next step, rather than go directly to financial outcomes, it is often helpful to look at the business or the operational impact of those activities. Does it lead to higher efficiency? Does it lead to better quality? Does it increase the speed of production? Does it improve retention? So what are the changes in the business that are the direct result of the activities you perform? Once you have that, then it becomes a whole lot easier to translate those business outcomes into financial outcomes, which is something that this finance team can easily measure and what budget decisions are made on. So the reality, though, is that most functions report only layer one, and the decisions get made at layer three. And if you are able to proactively bridge that gap, your credibility in the organization starts to go up considerably. So let's give you a sense again of the kinds of metrics we're talking about here. The metrics that are most commonly observed are in marketing. It again is customer acquisition cost, lifetime value, customer lifetime value to customer acquisition cost, marketing ROI, payback period, and so on. For HR, it may be cost per hire, turnover cost, revenue per employee, and so on. And we'll go into some of this in a little more detail in a moment. But here, all I've tried to do here is list some of the commonly observed metrics that are routinely used for each of these functions. So let's look at some examples here to make this real. For if we were, for instance, to take HR as an example, what you see here are the three layers that are typical for, say, an HR initiative. So in this case, the HR initiative is a 6-month manager development program with 120 participants. So if you look at it from an activity standpoint, it is the activity is the running of a management development program and 120 participants completing the program. That's the activity. So the layer 2 asks the question, why are we doing this in the first place, right? What is the business purpose of this activity? And if let's assume that the benefit here is a reduction in the voluntary attrition that happens at the company, at the management level, or at the manager level. And let's assume, for instance, that the program led to a reduction in the attrition rate by 7 percentage points from 21% to 14%. Now, the level 2 indicators are definitely an improvement over the activity indicators because now you can look at the business impact of it. But we still have not done the translation to then the financial outcome. So if there is a 7 percentage point reduction in the attrition, and that leads to, based on the size of the team, let's say 35 fewer departures, you now can take the 35 fewer departures and apply the average replacement cost of those 35 departures to come up with the benefit of the program. And the benefit of the program in this case is $3.9 million that was saved because 35 fewer employees departed voluntarily from the organization. So now the three-layered stack or the three-step process that we discussed in the last slide is now being implemented here. And we went from, hey, we ran more programs. We had more people complete management development programs to a dollar impact that is very visible and clearly understood by the finance team. So with that example, I'm going to look at some of the metrics for the various functions a little more closely. So let's start with HR again. So you have one of the metrics you see, the first metric you see is cost per hire, right? So here, what the finance team is trying to do is trying to get at how efficient you are at recruiting, okay? So if you look at the total recruiting spend and you compare it to the hires made, you get a sense of what it costs for the average hire at that company during that period. Turnover cost, on the other hand, might be, it focuses more on how much attrition is costing the company, right? So each time an employee leaves, we know that to replace that employee, it's going to cost the company let's say roughly 1.5 times the annual salary. So by HR tracking this measure, it is an indication to the company that what they need to do in other parts of the company may be more or less of a priority depending on how high this turnover cost is for the company. If you're having a high turnover cost, now that suggests that there are other actions that may be needed on the operation side to try and minimize this because now you have a direct sense of the dollar impact of that attrition. The next two measures are productivity-related measures. One says, hey, given the size of a company and the revenues we generate, how many employees do we have? So if we divide the total revenue by the headcount, we get a sense of how productive our employees are. How much revenue can be attributed to each employee we have? And this is a benchmark that can be evaluated against third-party benchmarks, meaning companies of similar size and in the similar industry, or it can be used to track improvement over time. So the HR department may be, if the numbers are too high, they can do analyses that helps them identify which functions, which groups may have excess capacity and so on, which then becomes a useful input for the finance team to come up with decisions to improve performance. Labor cost as percentage of revenue is a variant on revenue per employee. So instead of counting the number of employees, you're looking at the labor cost of those employees. So this tells you, if you look at a total cost of a company, how much is labor contributing to total cost? Again, this can be benchmarked against third party and or benchmarked over time. The last metric is a variant here of the turnover cost. And it's the idea here is that you focus on the most valuable employees in your organization because the cost of these employees leaving may be more than the average replacement cost. Right? And so loss of high performance may be something you want to track. And so that may be yet another performance indicator, which is directly relevant for the organization and that HR can usefully supply to the finance team. If you were to turn to marketing, Uh, Customer acquisition cost is an important metric that's tracked because it gives company a sense of how much they're spending on acquiring a new customer. It may be the case that in early stages of a company's life, the customer acquisition cost may be high, but the finance team might like to see how customer acquisition costs are evolving. Hopefully, as the company becomes more established and gains traction in the marketplace, the customer acquisition cost starts to shrink. If they're seeing a pattern that's not consistent with that, that may give the marketing team an opportunity to highlight, or provide input to the organization to in terms of other things that could be done to help improve the customer acquisition cost. Um, and the lifetime value could be another indicator that is another indicator that is often tracked. It tells you what kind of payoff you're getting from acquiring a new customer. And so, in fact, if you were to combine the lifetime value and or compare the lifetime value of a customer to the customer acquisition cost, you now have a sense of, hey, am I getting enough value from a customer relative to the costs I incur to acquire that customer, right? So again, another metric that's helpful. Similarly, a more uh, department or function-wide metric might be the marketing ROI. Um, how is what is the revenue impact of every additional dollar that goes into marketing, right? And then a variant on the theme of the customer lifetime value, this idea of how quickly does a customer become profitable. So when you're looking at customer acquisition costs and relative to the value, you're looking at how soon that customer becomes profitable. Because if you have a customer whose lifetime value is small, the customer acquisition cost may seem too high relative to that value. So it's again a variant on the customer lifetime value to customer acquisition cost ratio, but presents it in time period terms. If we were to now go to operations related metrics, one of the more common measures that you see is throughput. So you have the amount of time it takes, how much the manufacturing facility, for instance, is producing relative to the capacity it has, right? So it's helpful because it tells you, in a period where company is looking to maximize its revenue, it tells you how much revenue is even possible to make given the capacity available, and how much is really being made uh, in in as things are. Right? So it gives you a sense of how much units are being produced relative to what can be produced, and that is a efficiency measure. Another efficiency measure is cycle time. The more time it takes to cycle through production from start to completion, the more capital is tied up in inventory, and there is also the lost opportunity to produce more. Defect rates measure the cost of impact of poor quality. And because the poor quality means you got defective products, means that you have lower revenue, and there is both a cost of reworking if you are reworking it, or if it has to be it's lost opportunity, then you have a revenue impact as well. A measure that is often seen in manufacturing is the overall equipment effectiveness measure. What they're trying to do with this measure is measure the percentage of plant production time that is truly productive. And what you do here is combine three factors: availability, performance, and quality into a single score. And essentially what it does, it accounts for downtime, slow cycles, or the amount of scrap that's produced, or the amount of rework that is needed. And then the last metric you see here, the cost of poor quality. So again, another way to translate all of the failures and the effort of the rework and the returns, and trying to pick that up to try and understand what poor quality is costing the company. Moving on to IT. Again, we're looking at measures of the loss of or the activities, how activities might translate into lost revenue. So if you have downtime, you have the potential loss of revenue that comes from the inability to sell, or to collect revenue while the system is down. Similarly, the mean time to resolution might indicate that the more time the system is down, there's a revenue loss and potentially even penalties built into the contract when the system is not operable. Development velocity impact is yet another metric where you look at how soon the investment in a new feature converts to revenue. It's the efficiency with development translates to revenue. And then finally, you have tech debt costs, which is the IT equivalent, if you will, of deferred maintenance. Typically, it doesn't appear on the income statement until it becomes a crisis. So estimating and reporting it proactively helps IT leadership come across as financially sophisticated. So these are some examples of the various metrics that are observed in day-to-day in companies. And now I thought it would be helpful to work through an example and see how how an activity-based metric in practice gets translated into a financial metric. Right? So let's use a IT system that has a 99.2% uptime last quarter. So if you look at that number in isolation, that sounds solid, but it's a percentage number. It tells finance nothing about the risks or the cost of any investment that may be needed. Now, if you were to translate this into dollar terms, some of the things you might do is that 99.2% uptime means 0.8% downtime. Of the total hours in a year where the system ought to be operating, let's estimate that to be 2,160 hours. So which means a 0.8% downtime is 17.3 hours. The revenue that is lost by the system being down for 17.8 hours, we estimate to be $180,000. That's translated based on contracts and the typical sale price, the revenue generated per hour by the company. So that means that for the 17.3 hours, if the revenue per hour is $180,000, then so 17.3 times 180K leads to $3.1 million. That is to say, the downtime of 0.8% translates to 17.3%. And if the hourly revenue is 180,000, your total revenue exposure from the downtime of 17.3 hours is $3.1 million. You can then compare it, say, to an industry benchmark which says that the industry average uptime is 99.9%, which is a 4.4-hour downtime. So really, what this tells you is that our company has an excess exposure of $2.3 million of resulting from the 12.9 excess hours, 12.9 being the difference between the 17.3 hours that we have as downtime versus the industry benchmark of 4.4 hours. So now, instead of saying you have a 99.2% uptime last quarter, you have a number, and now you can make the case for the infrastructure investment you've been asking. The benchmark gap of 2.3 million is your opening line for your next budget conversation. So with that discussion on metrics, I'm going to turn to the final topic in this video, this first video, by turning our attention to benchmarks and benchmarking. Okay. I bring up benchmarking because a benchmark gap I found is one of the stronger opening lines you can have in a budget conversation. It tends to shift the discussion from saying something like, this is what we want, or this is what we propose, to a discussion which is anchored in third-party data. And the discussion might go something like, this is the gap, this is what the gap is costing us, and this is what we need to do to cut to lower that gap. So on this page, I've provided some benchmarks. These are typical benchmarks. These are based on public data. This may not always be the right benchmark to reference, but it gives you a sense of what ballpark benchmarks might look like and where you might go to get some of similar information depending on the specific question you're trying to address. So this benchmark, for instance, allows us to say, let's say, if we are at an 18% attrition versus a 12% industry benchmark, and if we use the Society for HR Management's salary replacement benchmark of 1.5x, so that difference of 6 percentage points in attrition, you can then quantify to, let's say, a $1.7 million annual exposure relative to peers. So suddenly that difference in attrition becomes a real number that the finance team can immediately recognize and respond to. So that brings us to the close of the first video. We will continue this discussion in the second video. But again, I want to remind you that many of the calculators you might need to perform some of these calculations are available on our website, as is other content you might be interested in. So please feel free to check out our website and our YouTube channel, the website at finance-library.com, and our YouTube channel at finance-library. So looking forward to seeing you in the next video. Thanks for taking the time. Bye-bye.